Joining us now for a Bloomberg Television and Radio exclusive interview, I'm pleased to welcome to the show Richard Clarida, Federal Reserve Vice Chairman, and my surveillance radio co-host Tom Keene, making his debut on this set as well. Good morning to you, gents.
It's good to see you, and it's a change. This is different than you and I expected 2 hours ago.
It's a solid jobs report that we thought we might have to make some excuses for maybe 60 minutes ago. It comes out a lot better.
And I think what will be great here, maybe I'll take a broader tack with the Vice Chairman, and I know there's lots coming off of Michael McKee's first question at that Fed press conference the other day. Vice Chairman, thank you again for joining us here at Bloomberg. I want to go back to a word identified with the Vice Chairman of the Fed, and that is solid. Yeah. We just had a more than solid jobs report. The President of the United States tweeting out about it. A few days ago, he tweets out, maybe we need lower rates. Define for us as a starter, what is the new solid that you see into next year?
Well, this was certainly a very solid labor market report, as we said in our statement. You know, we have ongoing growth in the economy. We have inflation near our objective. So the economy is in a very good place. You know, growth is, as we've characterized growth as moderate right now. The global economy has been slowing, and that's a factor. But the U.S. economy is very resilient, and these are good numbers. Both the GDP number and the labor market number surprised a bit on the upside. So that's a good thing.
Are those numbers, those GDP numbers, are they politically acceptable to this nation? It's great for economists like you to talk about 1.9% as a center tendency, but is that politically acceptable?
Well, I'm not going to get into the politics, Tom. Our job at the Fed, we have a dual mandate, maximum employment price stability. We've made some adjustments in our policy rate. We think they are and will continue to give significant support to the economy, and we have a favorable outlook for the economy.
John?
Well, let's talk about the outlook and the balance of risks around the outlook right now. How would you describe the balance of risks around that outlook, Rich?
Well, John, I would say for most of the year, the balance of risk have probably been tilted a little bit to the downside. Not so much because of the U.S., but we're part of the global economy. We've got a global slowdown. There are some pretty powerful global disinflationary pressures. And as we said in July, in September and this week, we felt it was appropriate to make some adjustment in our policy to provide some insurance or cushion against really sort of a softening global economy. You know, you saw that at the IMF a week or so ago, downgrading the global outlook. So we think the economy's in a good place. We think monetary policy's in a good place.
The balance of risk, though, still tilted to the downside?
I would say somewhat, yeah.
Looking at the economic assessment of the Federal Reserve Chairman, we're trying to understand what a material reassessment of the outlook would be to reach that benchmark for another move. Can you give us some clarity on that? What is a material reassessment of the outlook? How much data does one need to make that assessment?
Well, first of all, let's remember, what is the baseline outlook? The baseline outlook is for ongoing continued growth, a very solid labor market, and inflation near our objective. Obviously, if we saw accumulating evidence that we were missing on employment, we were missing on inflation, and we were missing on the growth needed to sustain full employment and price stability, then we would have to factor that in. We will be data dependent, but we're saying our baseline outlook now is policy's in a good place.
The next meeting's a live meeting?
Every meeting's a live
We're
meeting.
just trying to figure out what the next meeting actually is. Do you need a month of data to take another look at this? Do you need 3 months of data to take another look at this? How long does one need?
Well, Jonathan, we meet 8 times a year, and as we indicated and as we did back in October, if we need to, we have had meetings in between. So yeah, we'll just take the data as it comes in.
The data comes in, but the fact is there's an arch debate about two Americas. David Blanchflower up at Dartmouth talks about the underemployed. It's fine to have models. It's fine to speak as a public voice, as you are now, Professor Clarida. But the truth of the matter is there's two Americas. Chairman Powell is addressing this with a more social mandate from the Fed. How do you address into next year two Americas, one employed, fully employed, and the other really struggling?
Well, Tom, let me talk about that, because I think Chair Powell has very effectively conveyed what we at the Fed believe. You know, we have basically one instrument, which is to raise or lower the policy rate. So obviously it's a very complex economy, but what we do know, and we've had these Fed listened events, we've had 14 Fed listened events this year, and what we've heard from those events is the substantial, robust benefits of having a fully employed economy, the wage gains at the lower end of the income distribution opportunity. Now, Congress has given us a dual mandate, maximum employment and price stability. We have the privilege now to be presiding over time when we're close to full employment, and we think there's a real benefit to keeping the economy there. So that's the way we're focused on it.
Well, let's talk about that dual mandate. To what degree do you think the FX channel at the moment is hampering your ability to hit it?
Well, foreign exchange rates obviously go up and down for a lot of reasons, and I'm not going to say too much more about it than that as a Fed official. That the Treasury, Treasury Secretary.
You're sounding really spanning.
Let me finesse it just a little bit then. Okay. I don't want the policy prescription. I just want an assessment, really. To what degree, to what extent do you think the FX channel as it currently stands is curtailing your ability to hit your inflation target?
I would not say that that's an impediment to our hitting our inflation target.
We had a news story out here yesterday, a legitimate reported news story on the Chinese response where they demand tariffs be lowered. Can you inform Professor Clarida of Columbia University teaching Econ 101?
Been a while.
Who pays tariffs? Help us with this right now. Let's slow down. Here's this arch issue. My chart of the year is customs collections out 3, 4, 5 standard deviations. Inform all of us, including the president watching right now, who pays for these tariffs?
Well, Tom, I'm not going to get into trade policy, one. Number two, that's a very complex issue. It involves the incidence of the tariff. It involves profit margins. It involves exchange rates. I've not looked into it, and I have nothing for you on that.
What we have, though, in the U.S. economy quite clearly playing into all of this is a tug of war between a resilient consumer and weak business investment.
Yeah.
When you look at that at the moment, is it your outlook that you think business investment picks up before we see a crack in the consumer, or is it the other way around? How should I think about that at the moment?
Well, first of all, John, we don't see a crack in the consumer. I've said publicly in some recent speeches that in my professional career, which goes back more than 30 years, in the aggregate, the U.S. consumer's never been in better shape. Savings rate is high. There's been deleveraging. Income gains are strong. So we don't see the consumer cracking. There has been a slowdown and a weakening in business investment. That's a complex issue. And I think it involves a global slowdown and some other factors. And that's why, one of the reasons why that we decided in July to provide some modestly more accommodative policy, in some sense, to try to offset some of those headwinds. We have seen a rebound in housing, so the housing sector is now contributing to growth for the first time in about 6 quarters. And so you have to look at the whole picture, I think, John.
What is a hawkish cut? That was the phrase 2 days ago. Can you enlighten us? We cut interest rates, but there's a hawkish tone to that. Well, how did we get to the language of hawkish cut?
Tom, as you know, I spent decades as a Fed watcher, and if I were still a Fed watcher, I would be commenting on that. I can just tell you what we did do. We provided additional accommodation at the meeting, and we indicated then, and I'll say again, we think that monetary policy is now in a good place.
Who will benefit from that additional accommodation and the timeline that you get from consecutive rate cuts?
Well, Milton Friedman taught us that monetary policy operates with a lag. We just put these adjustments in policy in place, and so we would expect to see that begin to impact the economy, beginning in the fourth quarter and into next year. Generally, interest-sensitive sectors are going to benefit, durable goods in particular.
Your take, Rich, and the take of others at the Federal Reserve has been that an ounce of protection is worth a pound of cure. That was the argument when we were in and around 2.5% on the Fed funds rate. Now we've dropped 75 basis points. Do you still make the very same argument, or do you have a different calculation to make?
Well, again, we provided accommodation precisely because we saw some of these headwinds, and we thought that a recalibration of policy was appropriate. And as Chair Powell indicated, and I'll restate, I think and we think monetary policy is in a good place.
Whether it's the excellence of Stanley Fischer, and I think a lot of people watching Vice Chairman Fischer said, who is that guy? The same thing with you. They don't know the Richard Clarida of dynamic stochastic general equilibrium theory.
Maybe that's just as well.
It's probably just as well, and a lot of people would say that. The IMF did a meeting in Vienna 2 weeks ago where they talked about your work in this new phrase of fiscal space, dovetailing fiscal policy in. Do you agree with the central bankers that it's time now, on a global basis and even on an American basis, to find a fiscal relief to all the burden put on monetary officials?
You know, Tom, I really don't want to get into fiscal policy other than to say that that's really a decision in our case for the Congress and the President. The way we conduct policy at the Fed is we take fiscal policy as an input into our outlook, and I'll just leave it at that.
Have we engineered a soft landing, Rich?
The economy right now, first of all, the growth in the economy and the prosperity of the economy is due to hardworking, individuals and companies, and so that's really the source of the current strength of the economy right now. Again, I would characterize the economy as operating, in the range of trend growth. There's a range of estimates of trend growth. What we do know is that unemployment rate's near a 50-year low. let me also say that we saw a good indication on wages in this report. They're picking up. We as a Fed don't see wage inflation as a source of concern. It's not showing up in excessive price inflation. And let me say one more thing. The share of income going to labor has increased in the last several years, last 3 years or so, by about 2 percentage points. That's not getting enough attention as it deserves. And so as this economy expands and prospers, we do see those gains going to labor. And I think that, that's a positive development right now.
In the range of trend growth, that was your earlier response.
Yeah.
What is the range of trend growth, and where do you think trend growth is?
Well, we have a summary of economic projections at the Fed that we release 4 times a year. There's a range of views on that. I think the current median of the group is 1.7 or 1.8%. Suffice to say, I'm more optimistic on trend growth than the median.
Really? Where would you put it?
Well, there's a custom, at least among the governors, of not revealing our dots. But let me just say I'm more optimistic than the median.
You think we can get back to those levels?
Well, productivity is a function of not only innovation, but capital investment and skills in the labor force. But I have said, and I continue to believe, I think that we've seen a bottoming. We had a really slow stretch of productivity growth for about a decade, and I think it bottomed out about 3 years ago.
Right.
And I think that is a positive development.
Does the economy lead productivity, or does productivity lead the economy?
That's the $64 billion
okay
question.
there, Professor?
That's the $64 billion question.
I can go up to 202 next year.
Yeah, okay.
Let me ask you this. Mid-cycle is all the vogue. I mentioned hawkish cut. I knew you wouldn't give me an honest answer on that. Give us the British go short-term, medium-term, long-term. What in God's name is mid-cycle? What does that signal to our viewers and listeners worldwide?
Well, let me focus on what late cycle is. Late cycle is you think a recession probability is elevated. All right. So
and
we're not late cycle. Let's just say we're not late cycle.
Is the mid-90s parallel to what we're experiencing now a good comparison? Is that useful?
I think no parallel is perfect. Circumstances always differ, but I myself in several comments, including in interviews on this station and speeches, have made reference to the 95 and 98 episodes, because what they illustrate is that once central banks, under the leadership of Volcker and Greenspan, once you achieve price stability, it does give the central bank more ability to be nimble within a business cycle to adjust and recalibrate rates. And we saw that under Chair Greenspan in the 90s. And I think in retrospect, that was a decade-long expansion, and that was certainly a positive support for that.
Well said, but we are now near the zero bound, worried about Japanification, worried about Jan Moens at JP Morgan talking about a vector of the 10-year yield down. Give us some comfort that dynamics in the 90s can work here so close to the zero bound.
That's a very good point, Tom. That is a difference from the 90s, in that rates were starting from a higher level then. We made the decision as a committee in July, September, and October, understanding where rates are now, where the economy is, that it was appropriate to provide this accommodation. My good friend and colleague, John Williams at the New York Fed, had done some very important work on thinking about how to do monetary policy near the zero bound. And what I've said many times in my professional career, going back 25 years, is policy has to be forward-looking. Because of the long and variable lags, if you have an opportunity to adjust policy to offset shocks, you should take that advantage of that, and that's what I think we've done.
What's the trade-off, though, Rich?
Well, the trade-off is monetary policy is more art than science. It requires judgment. It requires a humble understanding that our models aren't perfect. And you have to put all of that into the mix. But again, just let me say, I'm very happy with where we are now with the stance of monetary
You sound
policy.
pretty optimistic about the U.S. economy. I've got to say, that's my takeaway in the first 15 minutes of this interview. Well, would that be fair?
I am an optimist. My mother and father raised me to be an optimist, but objectively, the economy is in a good place. This is the longest economic expansion in U.S. history, going back to the 1850s. Unemployment at a 50-year low, inflation near target. And our focus at the Fed is solely to put in place policies that help to keep us in this vicinity.
Part of the Clarida charm is you're from Illinois. You've got a different view. Hubbard's from Florida, Clarida's from Illinois, many others. There's a wonderful geography to our
and we're both the sons of public school teachers.
Well, okay, we'll go with that as well. Good morning to all the teachers
Glenn.
out there. But I'm going to say this right now. There's a different view in the Midwest right now. It's a Midwest flat on its back because of these tariffs. In agriculture, it's a Midwest flat on its back from manufacturing. You're optimistic, as John mentions. You mentioned the word solid, but it's only solid to a part of America. how can authorities and the Fed drag the rest of America somewhat flat on their back into a better America?
Well, Tom, it's a good point. As I mentioned a moment ago, the Federal Reserve essentially has one policy instrument, which is to raise or lower the policy rate. It's a big economy, 300 million people, 50 states, and there are a lot of dynamics at play, and we're humble in the ability of our tools to really focus on the overall aggregate economy. I'm obviously cognizant of those concerns and those challenges, but we're just trying to stick and do what we can to contribute to where the economy is right now.
Rich, let's explore that optimism just a little bit further. What is it about the current economy that differs from the middle of this year when the rate cutting cycle, the adjustment actually started? What do you take more confidence in now that you didn't see earlier this year?
Well, what I would say, John, is we've done the adjustment. I would be less optimistic about the economy if we had not made those 75 basis point adjustments. And so I think the optimism is a context of where policy is relative to the headwinds, and I think that's been borne out. Some folks were talking about the consumer is going to turn over, or the labor market. I mean, going into today, how many speculations did we see of a terrible labor market report? So the third quarter data came in on the upside surprise, and I think factoring in the adjustments we've made in policy is an important part of it.
Is this confidence in the economy, though, or in the policy setting?
No, the hard data on the economy is resilient. Our baseline, and I think shared by many others, is the economy will continue to be resilient, certainly compared to the situation that you see in Europe and in other countries.
I mean, it's a global challenge as well. We kid about Chairman Powell as central banker of the world. Let me have you be vice chairman, a banker to the world right now. The United States must lead with a solid banking system, Bernanke 101.
Yeah.
The United States must lead with a productivity differential. Is that at risk right now with the political turmoil? The headline of the paper of the New York Times today, bringing me back to Watergate of the 70s as well. Within the stew that we're in, what's the leadership the Fed can provide to get us to 2020 and beyond?
Again, we have a very clear, specific mandate from Congress. We don't get into politics. We have our tools, and we're trying to use the tools to keep the economy in a very good place, and I'll just leave it at that.
Are you finding it's more difficult to adjust monetary policy in an era where rates are so low abroad?
It is a factor that you have to consider. The U.S. is part of a global capital market. Capital flows in and out of countries when rates are low abroad. Capital flows into the U.S. That has implications for financial conditions in the U.S. And rates are low abroad for a reason. And they're low abroad because growth is disappointing. And that also has an impact on the U.S.
I'm going to go to leadership again. We spoke, Bloomberg Surveillance spoke to Barry Eichengreen of Berkeley the other day as Arch book, Globalizing Capital. What is the globalizing message our central bank can do to provide leadership to Kuroda, Lagarde, Carney, but more importantly, emerging market bankers as well? What is the to-do list globally for this central bank?
Well, that's an ambitious question. I think what we're focused on is, obviously, the dollar is a very important part of the global financial system, and I think the most important thing that we can do is to keep price stability as an important part of our of our goals and achievements. And certainly, if we go back to the 1970s, the U.S. was not providing leadership with high and volatile inflation.
I think we're wearing them out.
We're going to let him have a sip of his Diet Coke just there, and he can take a quick drink.
What's so important here, and this is really important, folks, as we speak to Richard Clarida, the Vice Chairman of the Federal Reserve System. There's, John, as you and I cover every day, this path over decades. Marty Feldstein, the late Martin Feldstein, telling me 2 decades ago about this persistence in Japan. And then it comes over to Europe, and now the fear, not here, is it comes over to us.
Can we talk about current market ops? Why this isn't QE? I get so many people around this table that either scream it's QE and then they scream it's not QE. Why is this not QE?
Well, it's not QE, John. This is really central banking 101. Historically, central banks, well before the QE era, grew their balance sheets with purchases of short-dated Treasury bills because there's as economies grow and prosper, there's an increase in demand for central bank liabilities. And if central banks did not organically grow their balance sheet, that would create a liquidity problem. So this is not QE. QE was really targeting the long end of the yield curve, 10-year treasuries, 30-year mortgages. We're basically just buying T-bills right now and adding liquidity to the financial system. So it's not QE.
Are you confident you can continue buying T-bills, reach your objective without coming down further out the curve? Can you do it all through T-bills?
That's what we said. We believe that we can do it through T-bills. We've indicated in the announcement we made on October 11th that we will be adding T-bills to our portfolio at least through the middle of next year, and we're confident that that's the right course.
Well, at the New York Fed, John Williams and the team there have to manage this on a daily basis. I know you said you don't want to talk about the fiscal dynamics and that, but do you have a different set of challenges with a $900 billion plus deficit? And the vector of that deficit is you manage the T-bill and further out repo market.
Tom, I don't think it's a challenge. It's just obviously something that we have to factor in. And under John's leadership, you know, we're certainly on top of that.
Richard Clarida, special thanks to the Federal Reserve Vice Chairman. It's good to see you again.
As always.
Good to see you, Rich. Thank you very much.